Welcome back. Dubai's total exports ran over 3 billion dirham mark last year, with 29% being new deals and 52% won by new exporters. The Department of Economic Development announced the figures on Tuesday, adding that companies in Dubai were the beneficiaries of 83% of last year's deals. 61% of exports went to the GCC countries, mainly within the construction sector, and 35% went to Africa, predominantly within the electronics sector, followed by Asia and Europe. Saad Al Awadi, Chief Executive Officer of Dubai Exports, stated that for this year, they will continue to focus on increasing the exports of small and medium-sized enterprises in Dubai, enhancing competitiveness of local companies and raising the level of their products to make them exportable. And the UAE's non-oil foreign trade in the first 10 months of 2011 surged to 759.8 billion dirhams, showing a rise of 137.3 billion dirhams compared to the same period in 2010. Data from the Federal Customs Authority shows a year-on-year increase of 22% for the UAE's non-oil foreign trade from January to the end of October 2011. Forbes Middle East celebrated its first English edition last night and revealed its ranking of the top 50 companies in the UAE for 2011. The launch also saw the list of the top 200 companies in the GCC. Etisalat came at the top of the list, followed by the National Bank of Abu Dhabi in second place. The banking sector dominated the ranking, with 19 banks making it to the list. The total assets of the Emirati companies reached $486 billion profits of $9 billion and a total market value of $66 billion. Ranking first on the list of the top 200 companies in the GCC for the year was the Saudi company Sabic. Saudi companies dominated the ranking with a total of 98 companies, followed by the UAE with 44. With that, let's now look at the stock indices across the GCC. By slashing the minimum wage and cutting pensions to start Greek austerity measures, how will this bring forward recovery? How long will it be before we see results? And what steps are to be taken next? Well, we spoke with Philippe Dauba-Pantanacce, Senior Economist at Standard Chartered Bank.
Actually, it might not bring forward the recovery. You're very right on this. And I would even argue that it is doubtful that Greece will manage to get back the debt-to-GDP ratio that is targeted in that plan. What is happening in Greece right now really is that, in a very simple terms, if you got over-leverage, if you piled mountain of debt, one of the first steps you need to take to actually address the problem is to cut in your expenses and, generally speaking, go back to a level where you live within your means. And that means really getting poorer. And this is really what Greece is going through, as harsh as it is. And since they cannot devalue their currency, what they're doing is an internal devaluation, which really means lowering your labor cost. And that is also very painful. The other part of the story is that the plan is supposed to address the problem of the structural growth potential for Greece. And that is going through, I would say, a modernizing of the Greek economy, especially liberalizing the profession that are regulated, but also fighting the black market or the gray economy, and generally speaking, modernizing the tax structure.